Hello to you. Thank you for being with us. Certainly when it comes to, I guess, the commodity element of your portfolio at the moment, we're seeing iron ore looking pretty strong at the moment. Gold prices also. Some weakness, of course, coming through in oil prices. But just give us your take on how you are seeing that resources sector at the moment.
Yeah, last week I mentioned that I want to be long or overweight most commodities, but most of that was driven on a weaker dollar, and I still believe that's the case. I still think on a trade-weighted basis, the U.S. dollar still has a long way to go down. I don't think that's going to bode well for gold per se, but I think it will help oil. In fact, I think it helped it today. And iron ore, given the fact it went from 95 to 53 back to 65, I think that will help too. But obviously, all commodities have their own fundamentals, but in general, if you're putting together a trade-weighted commodities portfolio, I would base my thesis on nothing other than a weaker U.S. dollar.
I'm also keen to get your take on when it comes to equities, this move that we're seeing between developed markets and emerging markets, because emerging market equities are seeing a lot of demand right now.
Yeah, they do. And, the emerging market trade is starting to become consensus trade. That's when I start to get a little bit worried, although I'm still overweight. I have been, probably will continue. I think the repricing of the Fed, at least the Fed expectations, won't hurt the emerging markets. I think their valuations are much under the developed markets and still have a long way to run. So with that in mind, I do think it's a good place to be. It's a little crowded, but yeah, to be really overweight into the emerging markets, especially in the financial sector.
So let's talk broader equity market performance then. What are you seeing at the moment? I guess actually keen to know in terms of missed valuations. Of course, we're in earnings season in the US. A lot of questions are being raised about whether or not companies, the fundamentals can support the high valuations and high prices that we're seeing at the moment, particularly in that tepid inflation and sort of patchy economic environment right now. Where do you see as being the missed valuations?
I see a consolidation ahead, especially in the United States. I mean, let's face it, right now the second quarter earnings season is going to be a tailwind, or at least, when you look back at the industrial production numbers we had, the PMIs, et cetera. But the earnings per share projections between the second and third quarter and the fourth quarter, it's almost doubling from something like $5 a share to $10 to $12 a share in the third quarter. And I just don't think we could sustain that when you look at the most recent momentum numbers we've had. I'm not calling for a correction. I mean, I think all asset classes around the world are expensive relative to the return. I just think we'll see a consolidation mode. And really, we're even seeing that now, where we're seeing the old playbook being dusted off, where, we have a Yellen speech, we have Netflix earnings, and then all of a sudden we have a super tech rally when the rest of the market tends to languish. So more of the same is in store.
And just also, we were touching on gold just a short while ago. Just keen to get a take really on how you're positioning that within your portfolio, particularly, of course, within this rising interest rate environment, and also with a lot of conflicting messaging coming through from global central banks.
Oh, yes. Yeah, no, it's a great question. And, that was one of the few commodities I got right at the beginning of the year is gold. And I've actually lightened up on it. I think you'll be able to buy it cheaper. My premise always is that gold tends to rally when central banks around the world have lost control or don't have that control. And now they're regaining that control. That's usually a negative for gold. I mean, it really is. When you see, with the first global synced recovery that we've had since 2007 or before then. So I just think gold's got, some ways to go down. I don't think rates are going to go higher, so that's not going to bode well either. I'm not calling for gold to be at $1,000 an ounce by any stretch of the imagination, but I do think we're going to see some consolidation there as well.
So when it comes to your overall portfolio strategy, you're going with what you've described in your research note, Larry, as being that Goldilocks view.
Yeah, I still think overweight Eurozone. I would stay with the domestic issues and financials. I wouldn't get involved with anything with exporting right now because of the currency rate differentials. I like overweight emerging markets. I really do like China. I like Mexico. I am neutral in the U.S., almost underweight, almost a sell signal, because I just think the risk reward is not there. And I'd be really choosy with metals, but I do think some base metals have some upside potential going forward.
On that note, Larry, we will leave it there. Great to have you with us this morning. Thank you so much.
Thank you.